Okay, so imagine this for a second. You have two companies, right? They're in the exact same business, they make the exact same sale, but they report wildly different revenues. It sounds chaotic, and honestly, it was. That chaos is exactly why we need to talk about IFRS 15. Think of it as the new universal rulebook that totally changed how every company on the planet has to count its money.
So, you might be wondering, why did we need such a massive overhaul? Well, the simple answer is the old system was broken. Seriously. Imagine trying to compare the financial health of two businesses when each one is playing by a slightly different set of rules. It was a huge puzzle, and IFRS 15 was designed to finally solve it.
All right, here's our game plan for this explainer. First, we're going to dig into the problem with the old way of doing things. Then, we'll unpack the new universal standard and the all-important 5-step model that comes with it. After that, we'll see how it all works in practice, and we'll finish up by looking at why this new rule demands so much more transparency.
Okay, first things first. Let's really diagnose the problem here. The old way of recognizing revenue, it was basically a messy patchwork of different rules. It just created a ton of confusion where there really should have been clarity.
And believe it or not, before IFRS 15 came along, the rules for a company building a giant skyscraper were completely different from the rules for a company selling you a smartphone. You had one standard, IS 11, just for construction, and another, IS 18, for pretty much everything else. It was kind of like having two different definitions for the same word, revenue.
And this fragmented system created some pretty serious problems. You had different rules for different kinds of deals, almost zero guidance for the really complex contracts we see today, and just a whole mess of inconsistency. So if you are an investor trying to compare a software company to a construction company, well, good luck. It was like comparing apples and oranges.
So, out of this clear need for consistency and, well, common sense, a new universal standard was born, IFRS 15.
And on January 1st, 2018, everything changed. This new standard just swept away all the old, confusing rules. And the goal here was huge, to create one single comprehensive model that applies to every single contract with a customer, no matter the industry, no matter the country.
Now, this slide right here gets to the absolute heart of the matter. This wasn't just a tweak, it was a fundamental shift in philosophy. The old way was based on this kind of fuzzy idea of transferring risks and rewards. The new way is razor sharp. It says revenue is recognized when a customer gains control. That one word, control, it changes everything.
And this is the official core principle. Let's just break that down into plain English. It really means a company should recognize revenue to show two things. One, that it actually transferred something to a customer, and two, that the dollar amount of that revenue reflects what the company truly expects to get paid for it. It's all about telling an honest, faithful story of the transaction.
So how do you actually apply this new principle? Well, IFRS 15 gives everyone a really clear roadmap. It's called the 5-step model. This is the new engine that drives all revenue recognition.
And here is that roadmap. It's a really logical sequence that every company has to follow now. You start by identifying the contract and figuring out the promises you made in it. Then, you determine the price, you split that price up among those promises, and finally, you recognize the revenue as you deliver on them. Let's walk through the most important parts right now.
Okay, so step 1 is just finding the contract. But step 2 is where it gets interesting. This is where we identify the performance obligations. You can just think of these as the specific individual promises in the deal. And the key test is whether each promise is distinct, like can the customer benefit from it on its own. This becomes the fundamental building block for how we recognize revenue.
Next up, in step 3, we have to nail down the price. But it's not always a simple number. You have to account for something called variable consideration. We're talking about things like discounts, rebates, bonuses, anything that could change the final amount you get paid. And this was a huge shift because companies now have to estimate all of these things from day one and build them into the price.
So once you have that total price locked in, step 4 is all about slicing the pie. If your contract has multiple promises, let's say you sell someone a new phone and a 2-year service plan all in one package, you have to allocate that total price across each part based on what it would sell for on its own.
And finally, step 5. This is where we actually get to recognize the revenue. But there's a huge decision to make. Do you recognize it over time or at a point in time? For something like a monthly subscription, you'd recognize revenue over time as the customer gets the benefit. But if those conditions aren't met, you recognize it all at once, at that single point in time when control fully passes to your customer.
So, that's the 5-step framework in theory. But how did thousands of companies around the world actually manage this massive change in practice?
Well, the standard actually gave companies 2 ways to get on board. The full retrospective approach was the really thorough one. Companies had to actually go back and rewrite their old financial statements to match the new rules. The easier option was the modified retrospective route, which let them just make a one-time adjustment on the start date. This is why you might have seen some pretty big shifts in company financials right around 2018.
But, just adopting the model wasn't the only change. IFRS 15 also brought in a whole new era of transparency, all thanks to its disclosure demands.
Honestly, this might be the biggest legacy of IFRS 15. It's not just about changing the math in the background, it's about changing the entire conversation. The standard requires a huge increase in the level of detail that companies have to disclose about where their revenue comes from. It forces them to be more transparent than they've ever been before.
And hey, don't just take my word for it. As the experts at PwC pointed out in their own breakdown, and I'm quoting here, lastly, but definitely not least important, we need to consider the disclosures, which have increased significantly from that which we had before. This wasn't just a small tweak. It was a fundamental shift toward open and honest reporting.
So at the end of the day, IFRS 15 is so much more than just another accounting rule. It's really a global push for clarity and for comparability in how businesses talk about their success. Which of course leaves one final question for everyone to think about. Is your business truly ready for this level of transparency? Thanks for joining this explainer.